Hi, you are welcome to this accounting episode. Today we'll be looking at accounting cycle and classifying accounts. The reference textbook once again is the 17th Canadian edition of Fundamental Accounting Principles, Volume 1. That's by Larson, Dieckmann and Harris. The chapter that covers this topic is the chapter 4, which is completing the accounting cycle and classifying accounts. That's the topic in this textbook that covers the episode we're taking today. If you have any other relevant textbook that covers this topic, you may make reference to it personally also. So going forward, the topics, the outcomes at the end of this coursework of this topic is a worksheet and its usefulness, the closing process and closing of temporary accounts for each period, prepare closing entry preparations, post-closing trial balance, completion of the accounting cycle, classified balance sheet, reversing entries and their purpose, current ratio calculation and its implications about a company's financial condition. If you remember, in one of the previous episodes, we mentioned the accounting cycle. We mentioned that transactions, when they happen, when the business engages in a transaction or does something that has outflow or inflow or going out or incoming of an item that can be quantified in monetary terms. In this case, it will be established as a transaction and it must be recorded, analyzed, and an accounting cycle must be taken till it gets to financial statements. So here, first thing is to analyze the transactions, journalize, post, prepare unadjusted trial balance, adjust, prepare adjusted trial balance, prepare statements, that's the financial statements. We have an episode in this channel that takes care of financial statements. You may check it for reference. That's income statement, statement of financial position, statement of cash flow, and statement of changes in equity. Then it's to close, then prepare post-closing trial balance. The worksheet, from the word worksheet, just like Excel, that you have worksheets where you work literally. So it is an optional working paper that can be used to simplify the preparation of financial statements. It is prepared before adjusting entries are made. It is not distributed to decision makers. This is, as it is called, worksheet. It's for the accountant or the preparer of accounts to have some workings before the final accounts are published to users. It is helpful in preventing errors, and it is often used by auditors. This is a sample worksheet, blank worksheet that has account, unadjusted trial balance, adjustments, which means unadjusted trial balance, when it is adjusted, like when it is prepared against the adjustment, we have the adjustment, our adjusted balances. So the balances we will have here is the adjusted trial balance. After the adjusted trial balance, we then proceed to prepare the financial statements. That's the income statement, the balance sheet, statement of changes in equity. So the steps taken are to enter unadjusted trial balance, enter adjustments, then prepare adjusted trial balance. One random example, okay, we have examples below, but simply put, for instance, if you have prepaid insurance in the debit side, 10,000, and in a month or in a period you have used 3,000 insurance, which means credit will be adjusted of 3,000, which means your balance in the debit of prepaid insurance will become 7,000. You had 10,000 prepaid insurance, you already use, or you use 3,000 of it in the period under consideration. So that's credit, that's reduction in asset. Prepaid insurance is an asset which is debited. So when it is reducing or being used up, it is credited. So the balance is in the debit side. So extend the adjusted trial balance columns, and then enter Then enter the net income or loss and balance financial statement columns. Then prepare financial statements. Now let's look at this step 1. Cash, supplies, prepaid insurance, equipment are assets and they will be in the debit side. They will normally have a debit entry. Accounts payable, unearned teaching revenue, notes payable, they are liabilities and they will be in the credit side. Remember account equation and debit and credit principle in the double entry. That is also a video that's in this channel. You may make reference to that also. Capital is or equity is also in the credit side. So liabilities and capital will be in the credit side. So Virgil climbed capital 10,000 credit. Then withdrawals reduce capital, so it's in the debit side. Teaching revenue is income or revenue. Then equipment rental income, these are revenues in the credit side, as expense are in the debit side. So the total unadjusted trial balance in the debit is 23,300. Credit 23,300 also. No adjustments made. These are the opening balances. These are the balances that nothing has been done to adjust them. That's step 1. Now step 2 is to now adjust the entries accordingly based on the ones you use. Now cash, no cash was used and no cash came in, which means there was no adjustment. Supplies of 1,050 was used because it is in the credit side. If you brought in more supplies, it will be in the debit side, which is to increase prepayment of insurance, of supplies rather. Prepaid supplies. Supplies is assets that you have at hand. So part that you have sold out or you have used up in production or in operation will be in the credit side. Prepaid insurance, you have used 100 part of it. Equipment, none used in the period under consideration. Then accumulated depreciation, that's because you used up the equipment, it is in the credit side. The asset remains 6,000 at cost, but you used it. So the asset at cost our principal, you must ensure that cost of an asset remains the same. That's non-current assets. But depreciation, accumulated depreciation would be increasing as you use up the asset value. Accounts payable, no increase, no decrease. Unearned teaching revenue, it was 3,000 here, but you have provided 250 part. So it will be debited. That is to reduce unearned revenue, and it will become earned revenue of 250 in the credit side. So 250 will reduce from unearned revenue because you have provided these services, and you have earned the 250 income. So we'll get there soon. So note payable, no adjustments. Climb of capital, no adjustment, no additional capital. Withdrawals 600, no extra withdrawals. Teaching revenue, there was 38 before and additional 250 provided. So this is an adjustment. Equipment rental revenue 300, no adjustment. Salaries, there was increase in salaries paid or incurred 70. So all these are adjustments. The red items are adjustments. Now as you are adjusting it, other things are being created to correspond to the entries. For instance, supplies was credited. That's supplies used. That is an expense. So as it is reduction here, it becomes an expense here. Supplies expense. Prepaid insurance, as it is reduced here, it was incurred in that period. So insurance expense. Accumulated depreciation, credited here, then we open depreciation expense account, debited. All expenses are debited anyway. So unearned revenue 250, and it's credited here as income earned 250. Then accounts receivable of 1,800 credited here. Then account receivable was debited here. Now if you look at these adjustments in total, total in the debit side equates total in the credit side. Once this equals this, which must be the case anyway in normal instance, if you have done the right thing, the total adjustment in the debit must be total adjustment in the credit. Was as you adjust one part, you create another account to correspond that entry. So next thing to do, which is step 3, is to add up or reduce accordingly or retain. 8070 cash, nothing happened, so it will remain 8070. Prepaid supplies will be 3600 debit minus 1050 credit. Because assets are in the debit side, any entry in the credit side is reduced. Liabilities, they are in the credit, anything in the debit side is to reduce it. Please take note of that. So step 3, now cash remains the same, supplies reduced, prepaid insurance reduced, equipment, the cost principle remains the same. Accumulated depreciation was created because it was used for 200. Accounts payable, no adjustment. Unearned revenue adjusted. Credit here minus 250 reduced. 6,000 no adjustment. 10,000 capital no adjustment. Withdrawals no adjustment. Teaching revenue adjusted. Remember we created 250, provided 250 service, so and another 1,800. This 1,800 means the service provided in that period that customers have not paid. So this is another 1,800. This 38, this was prepaid, so we have provided this service. This 18 was not even prepaid. New customers entirely, new services provided entirely. So we have the total of 5,850. Because this is credit, this is minus this and this. Then our equipment, okay, from here, yes, 300. Salaries expense, is it 300? Okay, yeah, I can see it properly here. So yeah, so salary expense 1,470. Okay, now this is continuation after the fourth column. Sorry, this is the third column. Trial balance unadjusted, adjustments, adjusted trial balance is the third column, which is here. Next is now to prepare the financial statements, which is income statement, balance sheet, and changes in equity. Now, all income minus all the expenses would give us net income. For balance sheet, all assets which are in the debit side minus all assets would be equal to capital and liabilities. So the total here would be equal to the total here. For income statement, the total expense would not have to be equal to total revenue. Means in many cases expenses would be less than the income, the credit side, which makes you to have net income. So when the revenue in the credit side is greater than the expenses, you have the net income. If otherwise, that's if revenue is less than the expense, you have the net loss. But for balance sheets, total assets must be equal to equity and liabilities. Now please note, net income is part of equity because it belongs to the owner. So net income answer that you have here, if it is net income, that means if revenue is more than expense, the net income is valued and it is added to the credit side, is part of equity. Now look at it from a clearer angle. Now look at the net income, 2065. It belongs to equity, 2065 in the credit side, which makes the total assets to be equal to total liabilities and capital. So it is on this note I'll wrap up this episode on accounts and adjustments. If you have any question, please leave it in the comments, and you may make reference to the previous episodes. Thank you very much, and see you in the next episode. Bye.